Welcome, everyone. Thanks for joining. Early August, first go at a sort of quarterly team webinar. I'm so thrilled to have some of you here with us, listening to what the team has to say. Very quickly, going around here, I'm Connor Brown, CEO and a portfolio manager. I've got Shweta and Chris on the webinar who co-head our fixed income team. Rob runs domestic equity strategies with me. Vin Walden is here, who heads our global investment effort. John Lim is on, who's an analyst supporting our equity work. Sarah Regala is here, who makes all of the magic happen as our director of marketing. And Michelle Nofel, many of you guys know, is our director of partnerships. So this is our first go at this. We're gonna try to keep it fun, informative, and brief. Maybe if we're brief, fun, and informative, you'll choose to join us next time. Feel free to shoot us emails afterwards if you've got any feedback on the format, what we could do better. Have some grace. This is our first time, so I'm sure we'll screw something up. If you want to ask questions, you can put them in the chat, and I think that'll come to the host and all panelists. Michelle's going to be in charge of asking questions at the end. You can also email Michelle at citydifferentinvestments.com. I know that email address is way too long. We'll figure that out eventually. It is plural investments. But to start off, we're going to go around the horn, talk to the portfolio managers on the call about what they're seeing in the market, what's most interesting. Rob McDonald, would you like to start?
Yeah, I'd love to. Thank you. So I thought I'd give some real-time thoughts on what we're thinking about the market. It's been a very interesting start to the year with a few stocks really garnering almost all of the attention. Large cap tech. It's been, artificial intelligence is just such an interesting topic. It's so exciting. There's so many possibilities. And so you can see why people would be really excited about it. And so for a lot of the performance so far this year has been a few large stocks. So a real time, but what are we thinking about? Where are we looking? The value we're finding in the market is in, the rocks that aren't being turned over by others. We're finding lots of value in stocks with low PE multiples, anywhere from 6 to 10 times, generating lots of cash and doing good things with those cash, buying back shares. That shows good corporate governance. And in the value world, these cheap stocks, a lot of times you have to wait for your idea to be discovered to make money on it. But if you have a company generating lots of cash, buying back the shares, the longer it takes for others to discover it, the more value they create. Just by them buying back their own shares at a discount, it ensures a good investment outcome either way. So places where we're interested are spots that sort of isn't as exciting on CNBC, but it's pretty exciting for the long-term returns.
AI as a theme is interesting. It's going to have big impacts, but generally where we're finding opportunity in domestic is that anything that isn't AI seems more interesting on a valuation basis to us. Is that right, Rob?
Yeah, that's right. There's some, this is AI is going to be with us, and a lot of big tech is going to be there and be very instrumental. But there's more than seven stocks out there, and some of them are going to go down a lot, and some of them go up a lot. We want to capitalize on that.
Awesome, thank you, Rob. Mr. Vin Walden, who, by the way, just figured out virtual backgrounds in Zoom. Almost had a really outstanding background that he was stuck on, but he got it fixed just before he started. Vin, where are you? What's interesting out there, man?
What stands out to me is the last couple of years. It's been quite a dramatic V-shaped market, as you may not recall now, but things were pretty awful last year until about September, and then switched from kind of awful to wonderful. such that we've had an extraordinarily strong run now this year and for the last 12 months or so. For us in City Different global portfolios, the second quarter itself is was positive, but not so remarkable. But overall, the last many months and this year to date has been strong, and we're real happy that we could outpace a pretty exuberant market, even though to Rob's point, we're not big investors in AI or even tech in particular. We're relatively underweight those areas. But our clients had the right mindset in general, and were patient, stayed with us, without exception. So we really appreciate that. I think we're very fortunate at City Different to have good clients so far. Some of them are even opportunistic and adding to their investments or joining City Different, when things were in the awful state last year. So that's great to see. Happy clients is nice for all of us. I think what's a theme that you'll notice in our global portfolios these days, and we've been writing about it off and on, is this energy transition that provides our team with a lot to dig around in, as far as the way our consumption and supply of energy is changing in this country or on a global basis just as well. So on the supply side, everyone knows there's a trend towards cleaner and renewable energy, and also now away from Russia and other unreliable sources as providers of natural resources. So those are big secular shifts that are underway. And on the consumption side, energy sector and the power sector are sometimes seen as maybe kind of stodgy, slow growth, slow to change kind of areas. But I think that's a little outdated at this point. And in particular, the electrification of transportation that's underway is a big secular megatrend, I would say. Tesla wants to sell, I think it's almost 2 million cars this year. Each car represents a lot of electricity. It turns out a new electric vehicle on the road is equivalent to about 20 refrigerators in terms of electricity consumption. So, just imagine if every household in America, plugged in an extra 20 refrigerators. That's a big deal for the electricity companies and the grid and so on. So yeah, this is just very, very fertile ground to follow these changes and dig around, see what we can come up with as far as long-term, undervalued opportunities. In Q2, as I said, the results overall not so dramatic. I think the best news probably was we did make a new important investment along this theme of the energy transition, and it's a company that we just published on our blog called Talon Energy. Talon is a Pennsylvania power producer, and they have one of the largest and best nuclear power plants in the country. Since nuclear is zero carbon and very low operating costs, we think that's a great place to be. So if you're interested in that or other themes that we've written about, check out our blog at citydifferentinvestments.com.
Awesome. Thank you, Ben. Mostly beers going in those extra 19 fridges in the house. Is that what you're thinking?
Yes.
Okay, over to the fixed income team. It's been pretty wild in your guys' markets. What are you seeing?
Well, let's first address the elephant in the room. Fitch downgraded the U.S. Debt this week. We think that's a tempest in a teapot, although the factors they stated are real and they're long-term concerns. The dollar is still the world's reserve currency, but 10 years of highly partisan government has real-world ramifications. In terms of the municipal market, Fitch said it will potentially downgrade pre-refunded bonds, student loan bonds, and housing bonds because of the government participation in those markets. We don't think that's a big deal because nobody's been paying for the re-rating of pre-res for a number of years now, and we don't own student loans and we don't own housing bonds. So that's not a big deal for us. The street has been changing its tune really from an imminent recession being just around the corner to a soft landing. Shweta and I, back in November, thought we could build a bull case for bonds and a bear case for bonds with equal conviction. So therefore, we moved our duration targets to neutral and have been that way for most of 2023. Inflation, which is, the boogeyman of the fixed income markets, has been declining. Core CPI and core PCE, the Fed's favorite inflation measure, has rolled over, but they both remain stubbornly above 4%. The Fed's target is 2%, so they still have a lot of work to do. Core CPI came in at 4.8% and core PCE came in at 4.1%. But today we've had some good news on the inflation front. Non-farm productivity came in much higher, 3.7% versus 2.2% expected. And that bled into unit labor costs, which are now came in at 1.6%, which was below expectations of 2.5%. The Fed increased short-term rates last month. No big surprise. They did it by 25 basis points. The market's currently forecasting a probability of an increase in rates in September and November of 17 and 19%. The economy is proving very resilient. Second quarter GDP came in at 2.4%, and Bloomberg estimated that the expectations were 1.8%. The economy is doing great. Unemployment's running at 3.6%. The JOLTS survey came down. Job openings were down. Job openings were down from the 10 million plus range to 9.6 million. But that still means there's 1.6 jobs opening out there for everyone looking for a job. Tomorrow's job reports, I think, will be market moving. As I said, the economy is resilient. Milton Friedman once said that inflation is a monetary event. Everybody's talking about the monetary aggregates rolling over. M2 has rolled over. It's been decreasing month over month, but there's still a heck of a lot of cash in the system. If you were to look at the amount of M2 outstanding, it's a 3.5 standard deviation going back to 1959. And at the same time, what we're seeing is that the velocity of money, how much it turns over, is beginning to pick up. And you need both to cause inflation. And that is before the Biden spending plans kick in, the infrastructure program. So we still think the economy is going to be on solid footing going forward. In the municipal market, we are at a seasonally high period in August, and we expect that in terms of valuations, we expect that to resolve itself in September. Current AAA general obligation ratios are a little better than break even. So, but we had 12 billion of supply come to market this week. So the dealers were getting a little nervous, especially considering that in both the taxable and tax exempt markets were up about 25 basis points over the last week, up in yield. So they priced their deals with extra spread to compensate investors, and we have been buying. We think this is a buying opportunity. So it appears that the Fed is close to the end of its tightening cycle. Money market rates are very attractive at this point in time, somewhere over 5%. But that could change, okay? And what happens when it does? So having spent much of my youth playing pool and invoking the spirit of Fast Eddie Felsen, I would ask you, what is your leave? How are you going to hedge yourself against the ultimate reduction in short rates and a decrease in yields on money market funds? One of the measures that people use is the spread between 10-year treasuries and 2-year treasuries. The curve is inverted, and at the end of June, that spread was minus 1.06%. The end of July, that spread was minus 92 basis points. Today, only 4 days later, that spread is minus 71 basis points. So what we're seeing is an event called a bear steepener. Short rates kind of staying where they are and long rates going up. That's good. So the question I leave you, and that Shweta will answer, how are investors going to avoid the cash trap? Shweta, I give it to you.
Thanks, Chris. So what Chris is referring to, the cash trap, is the short end of the curve, right? It has both for treasuries and municipals have looked so attractive for the last 6 to 12 months. And it makes sense that investors have piled on to the short end of the curve. If you're getting a 5% handle to invest in shorter treasuries and money market funds, why not? That makes a lot of sense. But remember that old adage, what goes up must come down. So this is what happened in January of 2001, when Fed funds rate were around 5.98%. And within 9 months, October of that year came down to 2.98%, so 58% drop. What we are not saying is that Fed funds rate is going to come down anytime this year. But what we are talking about or pointing to an underlying risk here, which is that the very short-term nature of money market funds. Money market funds have a maturity of somewhere around 28 days. So that's when you know you're getting that 5% yield. So how do you extend your duration? You hedge against this reinvestment risk and give yourself a sustainable dividend stream. So what we are proposing is take your money market fund and add a longer term bond component, maybe 15 months, maybe 18 months. We're partial to an 18-month actively laddered bond strategy alongside with your money market fund. So what that does is gives you the ultimate luxury, which is the benefit of time. Remember the flow of money into money market fund? What happens when all of that money exits? Whatever the next opportunity that this money is chasing becomes very expensive. So perhaps what Chris and I internally think is a more thoughtful way to protect your dividend stream would be extend duration, give yourself that time, is a combination of an active bond portfolio with the money market fund, probably say a 90-10. Without getting into the weeds with numbers, it comes about the same, but it gives you the hedge and the protection against interest rate volatility.
Awesome. Thank you, Shweta. It's been easy to make a lot of money in money markets or treasuries at the short end for a period. Maybe that's starting to change, and financial advisors and their clients need to be thinking about that, is what you're saying.
Yes.
Okay, great. With that, let me turn it over to Michelle to answer any questions. I do want to point out we really pride ourselves on transparency and accessibility here at City Different. So if you're feeling shy and have questions for the team, reach out to any of us. We want to be in touch with and build long-term partnerships with our clients and customers. So never hesitate to reach out and talk to any of the team members about anything that's on your mind. But Michelle, go ahead.
Yep. We had a question come in, Chris and Shweta, why have rates moved so much so far in August?
Well, I think it's because when we went into the debt ceiling kerfluffle earlier in the year, the Treasury reduced its cash holdings to keep the government funded and operating. And now they have to rebuild that. And not only that, they're thinking about, gee, the congressional clown show is coming back to Washington after summer vacation, and we may have, they may shut the government down again. And so let's build up our reserves to have enough cash on hand that we can keep the government funded. Now, I've seen Treasury bill estimates of anywhere from 5 billion to 55 billion. And they're also coming up to a big debt refunding next week, excuse me. So I think all that pressure has caused rates to move higher. I don't think, and let me be firm about this, I don't think it's because of the Fitch downgrade. Even though,
Shweta, do you have anything to add?
Yeah, I was just going to jump into everything Chris said. And in addition to that, remember that the Federal Reserve is actively shrinking its balance sheet. Also, the debt service cost. So we talked about treasuries, how, juicy yields of 5%. But remember what that does on the back end for debt service payment. Now, that shoots up and you're looking at a bigger federal deficit for which the Treasury has to issue more Treasury bonds. So what we are seeing this week and next week is a deluge of Treasury issuance coming into market.
Thank you. Team, let's step it up. Chris used both kerfuffle and congressional clown show in his answer. I'd like the rest of the team to try to rise to the challenge there.
Hey, Rob, you're up. You talked about how AI is interesting, but maybe not an area that you're buying. What are some stocks that you're excited about?
Yeah. Yeah. So I talked about low PE businesses generating cash and then doing good things with the cash. One example would be Flex. This is a contract manufacturer, so they make stuff for other companies. After the pandemic, a lot of companies realized that they had to change their supply chain a bit, and Flex is going to help them do that. So a lot more outsourcing, and historically, contract manufacturing was a bad business, and because the customer was really large and there's no power. But now you have smaller companies relying on Flex for their business, and it's good returns. And so you can see over the years, margins are steadily moving upward. So this is the PE today is probably around 10 times for a growing business, which used to be bad, but now we think it's better. And within the business, they also own a company called Next Tracker, which does helps with solar panels. So they actually have a tracking device that you need for a utility size solar farm. And they're spinning out that business, which is a high PE multiple, and then they're going to they're buying back shares. So it shows great corporate governance and a stock that's actually even cheaper than it looks on Bloomberg.
Cool, thanks, Rob. Hey, can I maybe one more, Rob? Will you touch on Burford? It's such a unique holding. I think it's an interesting one to mention.
Yeah, so Burford Capital, they do litigation finance, which is basically this is so B2B. So if a small business in Silicon Valley wants to sue Google, they won't have the resources to do so, even though they have a good case. So they'll go to Burford. Burford will give them money, and so there's not many companies out there willing to do this, and Burford's experts in the field. And so it's kind of like a private equity business that specializes in this niche, and I think it's a great business. They have great returns historically. They have this one lawsuit that's outstanding with Argentina, and it's crazy. It's been going on for years, almost decades, and we're sort of coming to the conclusion of it, and it looks like the award for Burford will be rather large, in the billions of dollars. And this is a company that has a few $1 million market cap. So we'll
$2 billion market cap.
Yeah, so we'll look out for news flow on this and see how it goes. But it seems like a great underlying business with a binary outcome that could be very positive.
Rob and I have been working together since 2007, and he's had investment recommendations we've invested in a series of really interesting private equity managers. And the litigation finance doesn't sound like traditional private equity. It's that same skill set that he's put to work there. I think it's really unique and interesting holding. Michelle, do we have one more question?
Yep, one more question, and it's for you, Connor. As CEO, a member of the audience would like to know what your thoughts are as far as the future of work and what that looks like.
Cool question. There was a Wall Street Journal article this morning even about the fight between executives and employees trading off balance for pay, fighting back against return to work requirements at investors. I know this doesn't work for every business, but for our business, which is so knowledge worker focused, I think if you have the right people, and I believe we do, these are all good people, smart, driven people on this call, trusting them to get their work done the best way they know how seems to me the best policy. It really empowers a team. So we at City Different have a remote first policy, but half the team's in Santa Fe. A few of us are in the office today doing the Zoom from here, and like coming into the office, but also sometimes work from home. And then some of the team, Shweta, Jong, for example, are zooming in from all over the world and doing a great job getting their work done from where they are. I think once you require 2 days, 3 days in the office, you've limited your potential job pool to just the geographic territory around whatever offices are offering up. So I know we are blessed to be in a knowledge worker focused world where we get to really focus on high quality, talented people to fulfill all of the job functions at City Different. But I think if you're in that same position, a responsibilities only work environment, a remote work first policy can work really well. All right, if you have made it this far, you've listened to all of our inaugural quarterly webcast. Please reach out if you've got any thoughts on what we did well, what we didn't, how we should change things up in the future. There'll be a replay available. We'll get details on that out, and maybe even cut up some of this and use it, get some of the smart things that Chris and Shweta said out in front of more people that weren't able to join live. Anything else from any of the team before we wrap up?
Connor, a question I've had recently from clients is, the outlook for equities question, just as an asset class. And, my gosh, things were so bad last year and now things are much better. Seems like, the trend is good and there's much less to worry about. So should we just, embrace that and be more enthusiastic now? Or should we look at it the other way and say, well, the evaluations are much higher and, the market's run so much. The S&P multiple is 21 times earnings now, which is not a bargain per se. And so, should I be cautious or should I be enthusiastic? And my own take on that is yes, you should be long-term enthusiastic and constructive about equities as an asset class. Of course we are. But it's also true that we just had, more than a year's worth of positive results in the last several months. So I think it's reasonable to temper your enthusiasm and sort of reset long-term expectations from here at this point. And most of all, beware market forecasters.
Yep. Anybody who says they're very accurate in predicting what's going to happen with the market is probably lying to you. I agree. I'm super interested to see what happens with this election coming up. That should be fascinating. And while I don't think it will have significant long-term impacts on the markets or bullishness, I do think we're in for a wild ride when it comes to the US election. I think we've got some additional questions that have come in. We'll make sure to get answers out to each of you individually, but in the spirit of keeping this brief, I think we're gonna end it here. Thank you so much, everyone that joined us. So we'll see you in a quarter.